Hi, I'm Patu from freefincal, and in this video, let's talk about market all-time highs and how frequently do they occur, and should we be worried about them. So every time the market hits an all-time high, people start worrying about it and say, "Oh, should I wait until it cools down? Sure, the market is at an all-time high. Should I wait or should I invest now?" And so on. So there have always been such fears. So if you let's look at the Nifty closing price since July 1990, and let's find out how frequently the market has traded close to an all-time high. So what I have done here is I have asked in this column. So let me click one signal here. There you go. So I've asked basically in this column if this closing price is greater than or equal to 90% of the maximum seen up to that point. So from here, the maximum of this to that. So if this price is greater than or equal to 90% of the maximum of all the closing prices seen, then this column C will have a value of 1. Otherwise 0. So essentially I'm asking how often the market has traded within 10% of the all-time high, and uh, excluding the first data point, which is obviously the 1. The total number of data points here is 6,989, and the Nifty has traded at 90% to 100% of the all-time high. So that is within 10% of the all-time high, 2,833 times. That is a lot. So 41% of the all reported closing prices have been within 10% of the all-time high. That's a significant number. So there's no need to be worried about the all-time high. It's a fairly common phenomenon. When a market sees an all-time high, more often than not, it will lead to new all-time highs and so on. So there's nothing to be worried too much about it. Also, we can turn this logic around and ask what is the drawdown. So I have a video on what is portfolio drawdown. So portfolio drawdown essentially means, so the price will be moving like this, and that's the maximum. How much has the prices fallen from this maximum down by 5%, 10%? What is the maximum fall? So that's called the drawdown, and the maximum fall is called the maximum drawdown. If you look at this graph here, so the blue line is the closing price, and those closing prices are found in the left y-axis. The orange lines is the drawdown, and that is seen in the right y-axis. And you can see here that whenever the drawdown is 0, that means it's a maximum. We have just seen how much it's been trading close to a maximum and so on. So this is the fall by 10%, and this is the fall by 20%, and you can see that during the 2008 crash, that's the maximum drawdown of a fall from a peak of about 60%. Earlier we have seen falls of 50%, a little bit above or below that, and so on. So if you take this data and turn this around, we can ask a slightly different set of questions. So we can ask, how often has the market seen more than 5% drawdown events? That is, a fall greater than 5% from maximum. How often has the market seen more than 5% drawdown events? That is an astounding 5,110 closing prices have been more than 5% drawdowns out of 6,989. That number is common to everything. So that's 73% of the time. More than 10% drawdown events, 59% of the time. More than 15% drawdown events, 49% of the time. More than 20% is 39%, and then from 20% to 30% is a big jump. More than 30%, it's only 22%. More than 40%, 8% of the time. More than 50% drawdowns, it's only 2%, but still that's 124 times. Notice that 583 closing prices have been a fall of more than 40% from the Nifty maximum, and 124 closing prices have been more than 50% fall from the Nifty maximum. That's a lot in terms of actual absolute number, but in terms of the total number of trading days we have seen, that's just 8% for more than 40% and 2% for more than 50%. So the point I want to convey here is more than 5% and more than 5% falls are fairly common. 5 to 10% or even more than 10% falls are still common. More than 15% falls are still common. It's only here when it more than 20%, more than 30%, and so on. There, that's where those are the slightly less common events. So you should not be worried when the market falls by 5% or more than 5%, 10% or a little more than that, and so on. Up to 20% falls, I think you can not be worried. I think there's an official definition of a bear market. I think more than 20% falls are considered to be a bear market, probably because of this. And that's it. So such drawdown events are essentially common. You should not, first of all, don't be worried about market all-time highs. Don't be worried about 1% fall, 2% falls, 5% falls, more than 5% falls. Up to 20%, I think you should recognize that. I mean, more than 15% drawdown events have been like half the time. So half the time, the market has fallen up to 15% of the time. So I mean, 15% drawdown is roughly 51% common. 51% of the time it's happened. So that means it's fairly common. So you should get used to this volatility. Unless you get used to this volatility, you will not be successful in equity investing. Please recognize the problem is not looking at these falls. The problem is going to social media and finding out what has this guy talked about the market fall, what has this guy speculated. Don't look at opinions, don't read any news, stay away from outlets, stick to your goals, stick to your portfolio management and risk management tactics. You should be good. So that's what I wanted to convey in this video. I hope I've made my point across. I'll catch you in another video. Thank you as always for listening.